A lot of people open a Roth IRA with good intentions. They contribute regularly. They choose solid ETFs. They stay consistent, and yet something about the account still feels underwhelming, not broken, just unclear. You add another ETF. You make a small adjustment. You assume everything will come together over time. But there's usually a quiet question sitting in the background. Is this actually set up the right way? Or am I overcomplicating something that's supposed to be simple? Because when an account as powerful as a Roth IRA feels confusing or stressful, the issue usually isn't effort, it's structure. In this video, we're going to break down 5 ETFs that can truly supercharge a Roth IRA in 2026. But this isn't a random top 5 list. This is a clean portfolio structure. Each ETF has a specific job. Nothing overlaps. Nothing fights against the rest of the strategy. By the end, you'll see how these ETFs work together, why this structure often outperforms more complicated portfolios, and why simplicity usually wins inside a Roth IRA. And most importantly, I'll show you how a Roth IRA built with this exact setup could turn a simple $100 weekly contribution into $1 million account, one that eventually generates over $2,000 per month in tax-free dividend income. But to understand why this works, we need to start with something basic: what a Roth IRA actually is. A Roth IRA is a retirement account where you invest money after taxes have already been paid. That detail is everything, because once the money is inside the account, everything grows tax-free. Price growth is never taxed. Dividends aren't taxed while they're reinvested. And when you withdraw the money in retirement, it's still tax-free. No yearly tax bill, no capital gains tax, no tax on investment income. That structure changes how compounding works. In a normal taxable account, taxes quietly slow growth over time. Inside a Roth IRA, nothing interrupts compounding. Every dividend gets reinvested. Every gain stays inside the account. And over decades, that difference becomes enormous. But here's the part most people overlook. That tax advantage also makes mistakes show up faster. If the portfolio structure is messy, if there are too many overlapping ETFs, or if the investor constantly tweaks the strategy, compounding works against you just as quickly as it works for you. And that's where many Roth IRAs start feeling harder than they should. One of the biggest reasons a Roth IRA starts feeling complicated is that most people never change the way they think when they open one. They treat it like any other investment account. Same mindset, same habits, same type of decisions. But a Roth IRA isn't just another place to hold investments. It plays by different rules. And when those rules get ignored, things start to feel messy fast. The first problem is overlap. It's easy to keep adding ETFs because each one sounds useful. One tracks growth. Another focuses on dividends. Another targets technology. Before long, the portfolio contains 8 or 10 different funds. But when you look closer, many of them are doing the exact same job. Different names, different tickers, but nearly identical holdings. The portfolio grows in size, but not in purpose. And when markets move, that complexity makes it harder to feel confident. The second issue is chasing a single idea. Some investors focus almost entirely on growth. They assume income will come later. Others go the opposite direction and chase dividends early, sacrificing long-term growth. Inside a Roth IRA, both extremes miss the point. Growth and income aren't supposed to compete. They're supposed to work together through reinvestment. Growth expands the portfolio. Dividends quietly buy more shares. Over time, those new shares create even more growth and income. There's also the emotional side that almost no one talks about. When a portfolio relies only on price movement, every market drop feels personal. You start checking your balance more often. you start wondering if something is wrong. Maybe you should rebalance. Maybe you should add something new. Maybe you should adjust the plan. At first, those decisions feel productive, but over time, they slowly turn the Roth IRA into something that demands constant attention. And that's the opposite of what this account is meant to do. A Roth IRA works best when it requires very few decisions. The more decisions you have to make, the easier it becomes to doubt yourself. And doubt leads to changes. Changes interrupt consistency. And consistency is the real advantage inside a Roth IRA. Because when taxes are removed from the equation, time and reinvestment do almost all the work. Once you start thinking about a Roth IRA this way, the entire portfolio becomes easier to understand. Instead of searching for the best ETF or the highest dividend, you start asking a different question. What role does each investment play? Every dollar inside a Roth IRA only needs to accomplish a few things over time. It needs to grow. It needs to generate income that can be reinvested. It needs to stay invested through good markets and bad markets. And it needs to do all of that without forcing constant decisions. When you think this way, a lot of investing questions stop being useful. It matters less whether one ETF slightly outperforms another in a single year. What matters more is whether each part of the portfolio has a clear job. Growth assets push the account forward over decades. Income-producing assets reinvest cash and buy more shares. Diversification spreads risk across economies. Stabilizing assets reduce the chance that you abandon the plan during volatility. When those pieces work together, the portfolio becomes easier to trust. And once the structure becomes clear, the first ETF almost picks itself. Because every Roth IRA needs one thing first: a strong growth engine. Inside a Roth IRA, growth isn't about chasing trends. It's about building a strong engine that can quietly push the account forward for decades. That role is filled by a broad market ETF like Vanguard Total Stock Market ETF, VTI. VTI represents the entire U.S. stock market in one fund. Large companies, mid-sized companies, small companies, thousands of businesses moving together. Instead of guessing which sector will perform best next year, the portfolio simply grows alongside the U.S. economy. Historically, that growth has been powerful. Over the past 10 years, VTI's share price increased by roughly 245%. That means $1 turned into more than $3 before dividends were even counted. This long-term growth is exactly why VTI sits at the center of this portfolio. It acts as the primary driver of long-term compounding. VTI also pays a dividend. The current yield sits around 1.1%. That income might seem small at first, but it has grown at roughly 6% per year over the past decade. Inside a Roth IRA, those dividends are automatically reinvested, quietly buying more shares over time. And those new shares generate even more growth and income later. Because VTI serves as the core growth engine, it carries more responsibility than any other ETF in this portfolio. That's why it receives 30% of the total allocation. It's large enough to drive meaningful growth, but not so large that the entire portfolio depends only on stock prices rising, because relying entirely on growth introduces another problem. And that problem shows up when markets fall. Even when the math still works, a growth-heavy portfolio can feel unstable during downturns. When prices drop quickly, investors start questioning their plan. They check their balances more often. They start wondering if they should change something. That emotional pressure is what causes many investors to abandon good strategies. And that's where the next piece of the portfolio becomes important. Income. Growth sets the direction of the portfolio, but income helps smooth the ride. Dividends continue arriving even when markets are down, and those dividends quietly buy additional shares when prices are lower. Instead of reacting to volatility, the portfolio keeps building ownership automatically. That's where the second ETF comes in. The Schwab U.S. Dividend Equity ETF, SCHD. SCHD focuses on high-quality U.S. companies with strong balance sheets and long histories of paying and increasing dividends. The current dividend yield sits around 3.6%, which is significantly higher than the broad market. But the real strength of SCHD isn't just the yield. It's the growth of those dividends. Over the past decade, SCHD's dividend payouts have grown at roughly 10% per year. That combination of solid yield and fast-growing dividends creates a powerful reinvestment engine because every year the portfolio receives more cash to buy additional shares. SCHD plays a stabilizing role inside the portfolio. Growth pushes the account forward. Income keeps the system running even when markets slow down. That's why SCHD also receives 30% of the total allocation. The goal isn't to chase yield. The goal is to create a steady stream of reinvestment that supports compounding in both strong and weak markets. When markets rise, SCHD's income compounds alongside growth. When markets fall, those dividends continue buying shares at lower prices. Instead of reacting emotionally to market swings, the portfolio keeps building automatically. And together, VTI and SCHD create the foundation of the Roth IRA. Growth drives the account forward. Income reduces the emotional pressure of volatility. But even with those two pieces in place, one major risk still remains. The entire portfolio is still tied to one country, the United States, and over decades, relying on a single economy introduces concentration risk. That's why the next ETF adds something the portfolio still needs: global diversification. Once growth and income are in place, the next problem to solve is concentration risk. Up to this point, the portfolio is still entirely dependent on one country, the United States. That has worked well for long stretches of time. But over decades, relying on a single economy means the entire portfolio rises and falls with the same market cycles. That's where global diversification becomes important. And that role is filled by the Vanguard Total International Stock ETF, VXUS. VXUS holds thousands of companies outside the United States, businesses across Europe, Asia, emerging markets, different currencies, different economic cycles. Instead of tying the entire portfolio to one country, VXUS spreads growth across the global economy. This doesn't necessarily make the portfolio more exciting, but it does make it more balanced because growth doesn't always happen in the same place at the same time. One of the most overlooked benefits of VXUS is income. International stocks tend to pay higher dividends than U.S. companies. VXUS reflects that with a dividend yield of roughly 3.1%. Even more interesting, those dividends have grown at approximately 13% per year on average. That creates a second stream of reinvestment that behaves differently from U.S. dividends. Instead of overlapping with SCHD, it adds diversification to the income side of the portfolio. Price appreciation for international stocks has historically been slower. On average, global markets outside the U.S. have grown around 7% per year. That's lower than the U.S. market, and that's exactly why many investors ignore them. But inside a Roth IRA, the goal isn't to outperform the U.S. every year. The goal is to reduce dependence on a single economy while allowing compounding to continue. Because VXUS adds diversification without dominating the strategy, it receives 20% of the total allocation. That's large enough to matter, but small enough that the core growth strategy still comes from U.S. companies. At this point, the portfolio now includes growth from VTI, dividend income from SCHD, global diversification from VXUS. But everything so far still revolves around stocks. And stocks, by nature, can swing sharply during market stress. That leads to the next problem. How do you introduce assets that behave differently from stocks altogether. That's where real estate enters the portfolio. Real estate represents something stocks don't. Physical assets, buildings, land, rental income, and those cash flows tend to move differently from corporate earnings. That role is filled by the Vanguard Real Estate ETF VNQ. VNQ holds a broad collection of real estate investment trusts, or REITs. These include companies that own residential housing, office buildings, healthcare facilities, data centers, commercial properties. These businesses generate income through rents and long-term leases. And those rents tend to rise gradually over time as prices in the economy increase. VNQ currently offers a dividend yield around 3.7%. That's higher than most stock ETFs. However, the growth of that income historically has been slower. Price appreciation for real estate has also been more modest compared to equities. Inside a Roth IRA, that's completely acceptable because VNQ isn't meant to drive growth. Its job is to add real asset exposure and a different source of income. Since real estate can also experience volatility, VNQ plays a smaller role in the portfolio. In this structure, it receives 10% of the allocation. That's enough to diversify income sources without letting real estate dominate the outcome. Real estate here isn't about speed. It's about balance, especially during periods of inflation or uneven stock market performance. Now, the portfolio includes growth, dividends, international diversification, real assets. But one final vulnerability still exists. Even diversified portfolios can experience sharp volatility during market stress. And solving that problem requires something most investors overlook: stability. That's where the final ETF comes in. Even diversified stock portfolios can experience sharp swings during difficult markets. And those swings don't just affect numbers, they affect behavior. Large declines increase the chance that investors panic, hesitate, or stop contributing entirely. That's where the final piece of the portfolio becomes important: stability. And that role is filled by the Vanguard Total Bond Market ETF BND. Bonds are often misunderstood. Many investors assume adding bonds means giving up returns. But that assumption only makes sense if bonds are judged the same way as stocks. Inside this portfolio, bonds serve a completely different purpose. They exist to protect consistency. BND holds a broad mix of U.S. government bonds and high-quality corporate bonds across different maturities. It isn't designed to be exciting, and that's exactly the point. Bonds tend to behave differently from stocks. When equity markets drop sharply, bonds often hold their value better or decline less. That difference creates a stabilizing anchor for the portfolio. In recent years, bond yields have become more meaningful again. BND currently yields around 3.8%. Price growth tends to be modest. There will be years when returns are flat, sometimes even slightly negative. Inside a Roth IRA, that's completely acceptable because BND isn't meant to push the portfolio forward. Its job is to reduce volatility so the rest of the strategy can keep compounding, because stability is important but shouldn't dominate the portfolio. Bonds receive 10% of the allocation, just enough to smooth the experience, but not enough to slow the long-term growth plan. At this point, every major role inside the Roth IRA is covered. Growth pushes the account forward. Income reinvests cash automatically. Global exposure spreads risk across economies. Real estate diversifies income sources. Bonds stabilize the overall experience. When all 5 ETFs are combined, the portfolio takes on a clear structure. The average dividend yield sits around 2.8%. That creates income early and supports reinvestment. Those dividends grow at roughly 8% per year, gradually increasing the number of shares owned. On the growth side, the blended long-term price appreciation averages about 8.4% per year. No single ETF controls the outcome. Each one contributes something different: growth from U.S. stocks, diversification from international markets, income from dividends and real estate, stability from bonds. Now let's look at what this structure can produce over time. These projections assume a $100 weekly contribution, dividends fully reinvested, long-term growth based on historical averages, no changes to the portfolio structure. After the first year, total contributions reach about $5,200. At this stage, the portfolio is still small and growth is limited. But after 10 years, projections show the portfolio reaching approximately $87,700. Compounding is starting to matter. After 20 years, the portfolio grows to around $339,000. Now, most of the growth comes from reinvestment and price appreciation, not new contributions. And after 30 years, the portfolio is projected to reach about $1.05 million. Of that total value, roughly $685,000 comes from price growth. Around $213,000 comes from reinvested dividends. Together, those two forces add nearly $900,000 beyond contributions. And at that level, the portfolio generates approximately $24,000 per year in dividends. That's about $2,000 per month, completely tax-free, without selling shares, without changing the strategy. That's the real power of a well-structured Roth IRA. Not complexity, not constant adjustments, just clear roles, steady contributions, and long-term compounding. If you want to see how a simple two-index portfolio can turn just $9 per day into a $1 million account paying over $7,000 per month in dividend income, click the video on the screen and I'll show you exactly how it works.